When we think about stable rental income, it's clear that not all areas are the same. And going one step beyond that, the risks by area is also not the same. What got us really interested in digging more is when we noticed big differences between Canada and Ontario's employment numbers. And as of the latest numbers, it turns out Ontario is more diverse than Canada as a whole, which could make it lower risk. Now, diversity is important, but it's also helpful to choose rental areas with more recession-resilient jobs. And this actually won't be clear if we just look at Ontario or even Toronto as a whole. Toronto is still a very mixed bag with lots of different areas, but if we zoom in on more specific neighborhoods, we will see a clearer picture of which areas ends up being better to focus on, and that's what we're going to be revealing in this video today. If you're new here, I'm Samantha Chan from Elevate Realty, and our brokerage wants to help you make smarter real estate choices in Toronto. Don't forget to like and subscribe if you enjoy this content. Let's begin. When it comes to comparing rental income, investors like to look at something called the cap rate, which is just a fancy way of comparing the annual net operating income divided by the property's market value. Now, different investors calculate this in different ways, which may or may not include vacancy rate and will probably not include tenant non-payment risk. But these two risks could be something that we should look more closely at if we enter a recession. So let's look at it. In Toronto, the vacancy rate is usually around 1%. So what this means is that rental units are rarely empty, and so excluding vacancy rate has generally been okay, with some exceptions. During the pandemic, residents did leave the core, and so vacancies did come up then, especially in Toronto condos. And now, if we do hit a recession, more job layoffs might also bump up vacancy rates. And then there is the risk of non-payment, and there is a higher risk here if the tenant's income gets slashed. So if you do want to reduce this type of risk, choosing jobs that are more stable during tough times will definitely help you lower this risk. So what might these jobs be? Well, healthcare jobs like nurses and government-funded jobs like public administration or education are always going to be more stable. Construction-related jobs in Toronto, with our focus on building more homes quickly, have also become less risky in recent years. And then we have jobs that are always needed, like cleaning or administrative jobs, which also fall into this more stable category if we enter a recession. On the flip side, jobs in finance, retail, sales, and tourism, unfortunately, will become riskier during economic downturns with more business cutbacks, layoffs, and reduced spending in a recession. So to play it safe, you might want to choose areas with a lower concentration of these types of jobs. Now, lucky for you, the hard part is done with compiling all of this data, and here is how different neighborhoods in Toronto rank based on highest to lowest stability. At the bottom of the list, downtown Toronto is probably highest risk due to its heavy renter concentration in finance, culture, and retail sectors, which ends up being not too surprising. The area that did surprise us a little bit more is Scarborough. And you can see here that many parts of Scarborough are actually pretty high risk, and that's because of higher than average concentration in sales and service related jobs. Now, moving up the list in the middle, we have the popular end user areas like Etobicoke, North York, High Park, and East York. And they end up looking stronger than the other ones that we just talked about because there is more job diversity overall, which does make them lower risk during a recession. But realistically, these aren't our typical renter hotspots anyway. And so as we move up the list, we see that midtown rental areas end up probably being the best choice if you are looking for more stable rental income during a recession. There is a good higher concentration of healthcare and government workers in these areas, and there's also a good diversity of jobs too. Adding to that, rents are typically at least a touch lower than downtown, which makes better rent to income ratios too. So if you're looking to cut down on rental risks, you might want to place your focus here. When it comes down to it, stable rental income is important, but it's also important not to forget about things like rental growth potential, appreciation potential, and development possibilities too. And having an expert to guide you through all of this will get you better and faster results, and that's what our team is here for. We're not your typical real estate sales brokerage, and instead, we focus on using numbers to make better real estate decisions in Toronto. And that can mean looking for stronger investments with positive cash flow, thinking about risk management, and looking for ways to boost returns like value add renovations and gentrifying areas. So if you do want to discuss your private real estate situation with us, just head over to this link here to set up a time to chat. You can also check out more content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think anyone else might like it too. Thanks so much for watching, and I'll see you in the next video.